All right, let's talk about a topic that's absolutely fundamental for the bar exam: capital structure. Now, this isn't just about memorizing formulas. It's about getting the why behind a company's biggest money decisions. If you can nail this, you're going to have a serious advantage on business analysis questions. Let's jump right in.
Every single company, whether it's a tiny startup or a global giant, has to answer this one question. How are we going to pay for everything we want to do? The choices they make, borrowing money or selling off pieces of ownership, have massive consequences. And for the exam, you've got to be ready to break those choices down. That's exactly what we're going to do here.
So here's our game plan for today. We'll start with the absolute basics, then we'll get into the costs of different types of capital, calculate the all-important WACC, talk about leverage, and finally, tie it all together with the big strategic picture. By the time we're done, you'll have a rock-solid framework for any capital structure question they can throw you.
Okay, let's dive into our first section. So, what in the world is capital structure anyway? Simply put, a company's capital structure is its specific blend of debt and equity that it uses to pay for everything: its buildings, its people, its projects. But listen, it's not just a list. It's a huge strategic decision. It's this fundamental trade-off between risk and return. The right mix can actually make a company more valuable by making its money cheaper. But the wrong mix, that can lead to some serious financial trouble.
So the key takeaway here is that management is always in this constant balancing act, trying to find that perfect optimal capital structure. They're weighing the lower cost of borrowing money against the extra financial risk that comes with it. They also have to think about control. If you issue a ton of new stock, you're watering down the ownership of existing shareholders. And then there's flexibility. If you take on too much debt today, you might find it really hard to get a loan tomorrow when you really need one.
To find that perfect mix, we first have to put a price tag on all the ingredients. And I'll tell you right now, for the exam, knowing how to calculate the cost of each type of capital, well, it's completely non-negotiable. First up, the cost of debt. This is basically the interest rate a company pays on its loans. But, and this is a big but, for making decisions, we always look at the after-tax cost. Why? Because interest payments are tax deductible. This creates something called a tax shield. Essentially, the government gives you a discount for using debt, which makes it cheaper. The formula is just the interest rate times 1 minus the tax rate. Easy enough, right?
Next, we've got preferred stock. This one is kind of a hybrid, sitting somewhere between debt and common stock. Since it usually pays a fixed dividend forever, calculating its cost is pretty straightforward. Think of it like a perpetuity. We just take that annual dividend and divide it by what the stock is trading for today. That gives us the yield, which is the return those preferred shareholders demand. Now for the cost of common equity, the return that shareholders, the owners, require. Since they don't get a fixed payment, we need a model, and the go-to is the Capital Asset Pricing Model, or CAPM. It looks a little intimidating, but it's really just 3 parts. First, the risk-free rate. That's your baseline, like what a government bond pays. Second, the market risk premium. That's the extra reward you expect for just being in the stock market instead of that safe bond. And third, beta. All beta does is measure how jumpy a stock is compared to the market. A beta of 1 means it moves in lockstep. A beta over 1, it's riskier, more volatile. Under 1, it's a bit calmer.
So this right here, this is the core trade-off in a nutshell. Debt is cheaper because of that awesome tax shield, but it comes with higher financial risk and these restrictive rules called covenants. Equity, on the other hand, is more expensive and it dilutes ownership, but it gives you way more financial flexibility since you don't have to make mandatory payments. It's this constant push and pull that management has to navigate.
Okay, so we've got the costs of the individual pieces. Now we're going to blend them all together into the single most important number for making investment decisions: the weighted average cost of capital, or WACC.
I want you to think of WACC as the company's hurdle rate. It's like a high jump bar. Any project or investment the company's thinking about has to be able to generate a return that can clear that bar. If a project's return is below the WACC, it's actually destroying value. So a lower WACC is always better because it lowers the bar and makes it easier for projects to be profitable.
Let's get our hands dirty with a quick example. Step 1, we figure out the weights. Here, the company has 50 grand in debt and 50 grand in equity, so it's a simple 50-50 split. Step 2, we get our after-tax cost of debt. We have a 6% interest rate and a 20% tax rate, so that gives us an effective cost of 4.8%. Now for the fun part. We plug it all into the WACC formula.
We take the weight of debt, 50%, times its after-tax cost of 4.8%, and we add that to the weight of equity, 50%, times its cost of 10%. That gives us 2.4% plus 5.0%.
And that all adds up to a WACC of 7.4%. This is our magic number. This company has to earn at least a 7.4% return on its investments just to keep all its capital providers, both its lenders and its shareholders, happy. Any project that can't clear that hurdle, it gets rejected. Period.
So now that we get WACC, let's play with it a little. Let's explore how leverage, which is just a fancy word for using debt, affects it. I mean, since debt is cheaper, it seems like a no-brainer to just use as much of it as possible, right? But is it really that simple?
This is the million-dollar question that gets us to the whole idea of an optimal capital structure. Yeah, on the surface, swapping out that expensive equity for cheaper, tax-deductible debt looks like a total win. But like most things in finance, there's a catch. And that catch is risk.
This chart tells the whole story. As a company starts to add a little bit of debt, the WACC goes down. That makes sense, right? You're adding that cheaper, tax-shielded financing. But as the debt levels get really high, the company's financial risk, especially the risk of going bankrupt, starts to shoot up. And when that happens, both lenders and shareholders get nervous and they start demanding higher returns for that extra risk. Pretty soon, those rising costs start to outweigh the tax benefits and the WACC actually starts to go up again. The optimal capital structure is that sweet spot right at the bottom of the curve where WACC is at its lowest possible point.
So let's go back to our example company. What if they decide to shift from 50% debt to 70% debt? Well, their WACC might dip down at first, but that move dramatically increases their financial risk. Their debt-to-equity ratio goes way up, they have more fixed payments, and that makes everybody nervous. Eventually, their lenders and their stockholders will demand higher returns, which can push the WACC right back up, totally wiping out any of those initial savings.
And this idea of risk brings us beyond just the math. We need to talk about the very real, practical problems that come with using debt. These are the hidden costs that you will definitely see questions about on the exam.
Okay, there are 3 big risks you absolutely have to know. First, liquidity pressure. Debt means you have fixed payments you have to make, no matter what. That's a constant cash drain. Second, covenant violation risk. Lenders put rules or covenants in their loan agreements. Things like you must maintain a certain interest coverage ratio. If you break those rules, you're in big trouble. And third, reduced financial flexibility. If your company is already drowning in debt, good luck trying to get another loan when an amazing opportunity comes along.
This quote is so powerful because it's absolutely true. A covenant isn't a suggestion. It's a hard limit. You trip that wire, and suddenly lenders might have the right to demand all their money back right now. That can easily push a company that's just struggling into a full-blown crisis. It's why managers are obsessed with watching these metrics.
All right, so let's put all of these pieces together into a simple framework you can use to analyze financing decisions, which is exactly what the exam is going to ask you to do.
Here is your 5-step attack plan. First, just identify the financing mix. What are we working with? Second, calculate the cost of each piece. Third, calculate the blended WACC. But please, don't stop there. Step 4, and this is the most important part, assess the impact on leverage, liquidity, and those pesky covenants. And finally, step 5, interpret the big picture. Does this financing choice actually support the company's strategy? And just a heads up, exam questions might use messier numbers than our simple example, but this exact 5-step logic will always get you to the right answer.
And that leads us to our final thought here. Is the lowest possible WACC always the best path forward? This question really gets to the heart of capital structure. It's a strategic dance between the numbers, trying to get that cost as low as possible, and the real-world needs for stability, for flexibility, and for control. Understanding that trade-off, that balancing act, that's the real key to mastering this topic.